We are back. Sam Cedar on the Majority Report on the phone. It is a pleasure to welcome to the program the Arva E. Strickland Distinguished Professor of History and Black Studies at the University of Missouri and the author of Land of the Fee, Hidden Costs and the Decline of the American Middle Class, Devin Fergus. Welcome to the program, Devin.
Pleasure to be with you, Sam. I wish it could be on a bit brighter topic and subject, but it's a pleasure to be with you nonetheless.
Well, what was it that led you to look at? Well, maybe we should define fees first, just so that we get a sense of what we're talking about.
Sure, absolutely. I use this expensive definition of fees. So by fees, I'm talking about any cost or expense which is in addition to principal. The private sector, for instance, plays kind of a shell game in order to sort of circumvent regulators often. And so, for instance, when payday loans first hit the market in the early 1990s, one of the ways in which they tried to circumvent, especially sort of state and some level federal regulators, by saying, no, we don't charge interest rates, so this isn't usury. These are actual fees. These are sort of administrative costs, administrative fees. And so again, the use, my use and application of fee is sort of an expanded one. It's anything that's in addition to addition to principal. So, for instance, an origination fee, as I gave the example with the payday lending industry, it could many times really be a fee as a de facto APR or interest rate. Default fees, prepayment penalty fees, as you would find, in, for instance, in subprime mortgages. And so these fees come in all kinds of shapes and sizes and colors, but it's in effect anything that's beyond the principal loan amount. And we see fees in the public sector, right? Fee as this sort of proxy for taxes, and so we can have that kind of brief conversation if you want to as well.
Well, I mean, I remember that back in the day when Mitt Romney was governor of Massachusetts and he promised no new taxes, and then he just basically instituted a ton of new fees. I mean, the big problem, it seems to me, with fees as opposed to taxes is that fees are far more regressive in terms of a form of revenue for the government, and also far less, I guess, transparent.
You hit the nail on the head. I was gonna weigh with the transparency argument, but you already did it precisely. Far less transparent. And often we find with fees that they're often difficult and almost impossible to opt out of. And so the implication of a fee is that a fee is sort of item driven. But we know, let's say, with higher education, so the state of California may not raise its tuition, but they sure as heck raise their fees. I'm a university professor. Students at the University of Missouri have to pay tuition, but there are these in-cost fees, and if they don't pay the fee, the user fee, they cannot sit in my classroom. And so the implication is that fees are sort of an itemized sort of thing, an a la carte sort of thing. But in reality, these fees are often critical, integral to the cost of a product, and it's impossible to opt out of. In the same way that often taxes are. So absolutely right. Mm-hmm.
So you've, I feel like you have already half answered this, but just give us a sense of the size of and the importance of these fees in a broader story for particularly the middle class.
Sure. And so what we find is that, again, the cost of these fees cost over $1 trillion per U.S. house. I mean, not per U.S. household, for the U.S. And broken down to let's say an individual median income eats up at least almost half of their income. And so we're talking, and I'm talking about particularly fees, and this is point two to point out, Sam. My work really looks at often fees in critical areas of upward mobility. So I'm not necessarily talking about, let's say, a cable user fee or something like that. And that's important and significant, or a cell phone fee. Again, I wrote a piece a few years ago for New York Times about the rise of phone fees. but I'm primarily talking about fees that are essential areas of upward mobility. The fees associated and then things like housing or higher education, fees that are linked to employment. And we could sort of talk about the ways in which the private sector, the most ubiquitous and common response to the issue of wage stagnation. And then what takes us from home to school and work, fees that are associated or attached to transportation. Particularly, employers want people with, quote, reliable transportation, i.e., a car. And that's what employers mean by reliable transportation. And then there are fees that are associated with, again, the automobile, particularly, or insurance fees. And so what we find is that not just they have fees sort of escalated in all areas, but particularly these four spheres in which have been critical for upward mobility: housing, education, and employment, and what takes us from home to school and work, the automobile. And these fees have created obstacles for barriers for entry into the middle class. And they've also worked to actually erode the middle class in various ways.
Let's talk about this is timely. I think my audience is aware that I had a debate with a guy who I don't know, you may be familiar with. He spends a lot of time on college campuses from Turning Points USA about sort of the about the middle class and some of these things. Particularly, we got into the housing crisis and the subsequent financial crisis in 2008. And let's talk about housing first in terms of these fees and what the implications are, and how, in many respects, I mean, I am familiar with some aspects of how the fees drove this crisis, and that we've talked about on this program, both, I think, in the origination of mortgages, but also even in the wake of the crisis. The allure of fees for a lot of these banks was greater than their desire to refinance or to I should say amend existing mortgages under HAMP. But tell us where fees play the most impact in the story of subprime.
Sure, absolutely. And so what we found with, for instance, the rise of the subprime mortgage market is that all of these the subprime mortgage loans or products which had these creative or toxic instruments, prepayment penalties, which is one of my favorite sort of financial instrument, mortgage toxic. It's sort of counterintuitive. It penalizes someone for paying their bills earlier on time. And so, I mean, that would be sort of one example. The balloon payment fees, as well as adjustment rate mortgage sort of charges or fees. All of these aspects and products that are associated or attached to subprime mortgage, all of them increase the likelihood that a borrower would go into default. And so, again, each of those aspects that were associated or attached to the subprime mortgage. And you're precisely right. Initially, subprime mortgages get marketed to people who have less than stellar credit scores, i.e., something less than sort of 660, but it becomes so profitable that by the time we get to the financial crisis, the average prime borrower was being sort of shunted into or channeled into the subprime mortgage market just because of the profitability of these subprime mortgages. And so, again, they become extremely sort of profitable. And here I'm going to sort of say this to you, Sam. I'm actually, I'm also a visiting professor in Northern England at the University, Northumbria University in Newcastle. And then in UK, it's conservatives who are pushing for creative and inventive ways to help consumers have stronger credit scores. Specifically, it's conservatives who are arguing that, let's say, your rent be included as far as your credit score, right? It would be wonderful in the U.S. if you would find conservatives who would make an argument that let's not try to channel people into these subprime mortgage markets like we're having people now do today by saying the underwriting standards in part or at least under the Obama administration, were too tight. We need to loosen those standards. It'd be great if we could have conservatives in the U.S. who would actually make the argument. Um, let's redefine what's a quality credit history, and not simply look at the history of mortgage borrowing, mortgage lending, but look at people who pay their utility bills on time, pay their rent on time. Those kind of ways could, if you use that, it would actually help borrowers increase their credit score, which would mean that fewer borrowers would actually be shunted into these subprime, or now it's called non-prime markets. Is it a thorn by a different name is still a thorn?
Right.
Now it's called non-prime mortgage products. And so it'd be wonderful if conservatives in the U.S. Would take a page out of conservatives, at least in the UK.
And people should understand that the subprime is just simply a way of justifying far more fees, right? So there is because the idea is that what we're not only do we jack up an interest rate because we're theoretically taking more risk, but also what is the justification for the fees in this instance? We're taking more risk, but we want to take more risk so that if you pay this thing off, there's a prepayment penalty, or is it also that there's an awareness of there's just probably a correlation between people who have poor credit scores and people who are not financially savvy?
That correlation is absolutely is there as well. People who have lower credit scores aren't financially educated, and so we can. There's so much to discuss here, Sam, because we can argue that it's not necessarily financial education is the key, and in fact, we've gone through a period now, the last 30 years, in which financial contracts and documents have gotten exponentially longer, right? And at the same time that the individual and the time they have to process all this information, that time has gotten increasingly lessened. And what I mean by that is individuals now today commute much farther than their grandparents or parents did 30 or 40 years ago to go to work. You're also working longer hours than people did a generation or two ago. So you're working longer hours, you're commuting farther. You're also in this sort of what I like to call this sort of extracurricular arms sort of race. I'm a parent of a child. My child just came from French class. He has martial arts class. He's in all these extracurricular activities. Why? Because he's competing against other kids of his same sort of class and cadre. And so we experience now is that individuals have less time than ever before to read and process these complex financial documents, which have actually gotten much longer over the last generation. And so how do you square this circle? And the way you square this circle is by bringing in financial regulators and having them delegate responsibility. And now the private sector understands that there's a process of information asymmetry, that you have less time to process this information, and that financial literacy is really a canard or a red herring because of for sundry reasons. Some I sort of laid out, others we can sort of get into, and so they take advantage of borrowers across, I'd say, the income spectrum, but is most devastating on historically vulnerable populations.
And the Consumer Financial Protection Bureau went a long way in requiring more plain English and shorter forms, particularly, I don't know as much for mortgages, although there was certainly reforms in that process, but across the board on some of these contracts, particularly I think it was, credit card contracts and whatnot.
Absolutely right. And we see what's happened there with the current acting director Mulvaney, at least, going through a process of catch and kill negative reports by his staff, who come out with negative reports about the industry. And so and this is one of the great ironies, right? For a long time, conservatives have made the argument, we don't need regulation, we just need greater, fuller disclosure of financial information and let the consumer decide. And what we experience now in the last few months is actually these sort of same pocket or slice of conservatives providing less information through this via these catch and kill of reports that CFPB have been trying to put out, but again, Mulvaney and others, as well as Betsy DeVos, who's an education department, have been catching and killing and suppressing. And so, yeah.
And let's talk about student debt. You bring up Betsy DeVos. One of the things I know the Trump administration has done in terms of deregulation was we have this massive problem in this country that it was actually quietly, I think one of the things that the Obama administration was doing quite well was beginning to crack down on what is not 100% a scam. Nothing ever is, but the for-profit university industry is largely an extraction machine trying to extract public money via student loans to students, and they tend to be a little bit older students who are going to these universities ostensibly to increase their earning potential in the business world. There's very little data to support this, and there was a regulation that if you were an institution that was putting out was handing out diplomas to people and they would go back into the workforce and there was no return on investment, you had certain limitations as to how much revenue you could derive from student loans. And Betsy DeVos basically said, "Oh, we're lifting that. You can keep pumping out people with essentially with a product that is defective, and we'll still keep giving you money." Talk to us about how the student debt bubble grew and what the implications are, and particularly in the context of fees.
No, you're absolutely right. And the origins of the growth of the student debt bubble really dates back to the Reagan administration. And here I'm going to sort of take just a bigger, broader step back and have a look at a sort of almost a sort of meta view. And it was just a fundamental philosophical shift that occurs by Reagan under Reagan. And so the architecture of the financial aid program really sort of gets in place in the 1950s under Dwight Eisenhower. Now, a Republican. Now, Eisenhower wasn't some flaming liberal, but actually in many ways was sort of reticent about even the financial aid program. But he sees the value of financial aid for college students, particularly as a means to address national security issues. And so Eisenhower and others sort of erect the financial aid system. And so since the 1950s, the financial aid program system has been a bipartisan sort of project of both liberals and conservatives. And those who are students of U.S. history know about the consensus era of American history. And this is sort of a reflection of that. So, but in the 1980s, what you find is a fundamental and a dramatic shift by conservatives who begin to see the expansion of financial aid in its existence to students, and begin to see students not as future tax contributors, as Eisenhower and others saw, Eisenhower and obviously Lyndon Johnson, but in the 1980s begin to see students as tax eaters, not as future tax contributors, but as present-day tax eaters. And imagine and looked at and use a rhetoric of using students as similar to those who are on welfare, so the welfare queen, or the unemployed father who's bilking money out of the system, or grandma on Medicaid, and then basically sort of lump the college student in with quote unquote the undeserving poor. And with that sort of mindset, what they did was they rolled back low interest student loans, they rolled back grant programs, and invited the private sector more so into the funding and finance of higher education. And that invitation to the private sector gets enlarged in the 1990s under Clinton, but primarily it's actually radical Republicans who do it. And remember the Congressional Republican Revolution of 1994. And they basically pushed back against something called direct lending in the 1990s. And they really muzzle Clinton and those who are pushing for direct lending, and they expand the private sector market and push back against sort of government regulators in education. And what we find with this rollback of direct lending in the 1990s
Can
is that yes.
elaborate if you could on direct lending. Just explain to us what that program is.
Sure, and I'm going to sort of say that direct lending is almost as it sounds. And so rather than a system in which, well, so direct lending is basically where the government has lends money primarily from the Treasury directly to college students, or gives it to the financial office in the college, and then they disperse it to college students. And that system really cuts out the middleman. It cuts out, for instance, the subsidy. Banks which might be subsidizing the loan. It often cuts out the loan servicer, and so it was more of a direct lending from government to the student. And again, that system which cuts out all these middlemen, whether it's the banks on the front end, or really student loan services, reduce the cost of the student loan. I mean, if you can imagine, just the administrative costs are cheaper, right? And not simply the administrative costs are cheaper, but also the actual loan product itself is cheaper. Now let's imagine this, Sam. Because the loan itself is cheaper, it means that the student who has to pay back that loan has to pay back less. And what we know, in whether it's mortgage market, or whether it's payday lending, or whether it's or higher education, if a particular financial product is cheaper, as logic dictates, it means that the borrower is far more likely to pay it back. And so that means that the borrower is far less likely to go in default, which means that the taxpayer who's actually funding both the direct lending as well as subsidized lending programs is far more likely to get their money back. So the government gets their money back, students get their money, and they get it faster. And so it's a system which actually worked for every population except for the financial services industry. And so because it didn't work for them, they push back and they pressure lawmakers to bring them back into the system. And this is what happens in the 1990s. And they push out direct lending, and they bring back the private sector. And then you see a whole slew of abusive practices and quid pro quos. And once government gets pushed down in terms of direct lending program, private sector comes in, and then they begin to give sweetheart deals to financial aid officers, kickbacks of various sorts. We just had a World Series game last night. Unfortunately, my beloved Dodgers lost. But let's say in the 1990s, you wanted to go see your Yankees play in the World Series. The bank might have a couple of tickets for the financial aid officer, and they'll give that financial aid officer some tickets if they would give them access to student lenders. Now, once the bank got access to the student lender, to the student borrower, I should say, they didn't care. The university or the education financial aid office didn't necessarily care the kind of terms that were given.
Right.
They were just caring about the kickbacks that they would get. And this is a system that existed from the 1990s through the 2000s, and we see several state attorneys general with lawsuits against various student lenders through this system. That was the abusive system, and the great shame is that DeVos and the Trump administration want to go back to this sort of wild, wild west sort of attitude of the 1990s and 2000s, where there's all this abuse taking place. We see the origins and rise and spread of student loan abuses and student loan debt. So,
all right. So, just to make it clear, and also to take the opportunity to state that I'm a Red Sox fan, and so I'm very happy about last night. But
you'll be happy about tonight too, I'm sure.
I'm hoping so. But so we had this type of abuse where there was sort of like extraneous middlemen that were placed into the process of delivering government-backed and government really funded loans. We threw that off. We still obviously have a huge debt problem, but now we're starting to see first the sort of the first order problem we have is fees that are generated and extraneous from private debt collection agencies that are now making their return back, following the Obama administration, where there was a significant push that, to the extent that it could be done just through executive order, to push a lot of these people out from the loan process. We still have a massive problem with loans, obviously, and a problem with the rising costs of education. But this is sort of like an added on attribute. And so what is that? Do I have that history right? That they were pushed out of the industry to a certain extent, and they're being brought back in?
No, no, absolutely right. Push out industry to a large extent through direct lending, and now they're being brought back in by the DeVos administration. And again, I'll stress this too. It's by ideologues, because um, if you want to do a simple cost benefit analysis, these loans are still cheaper and more efficient if done by government. And so if they're really concerned about what's the more efficient sort of product, it would be to keep the middlemen out, and to have a direct lending program. And this is actually, again, but both bipartisan administrations have done studies and research on this. And so, for instance, Lawrence Lindsay, the Republican under George H.W. Bush, I mean, talked about how efficient a direct lending program was vis-a-vis guaranteed student loans. And so, but again, this is driven by people with a sort of particular agenda, and also by this sort of close relationship with the donor class, the financial donor class, and those two things have created and created this problem. I will say this one sort of coda too, that I view as not simply an add-on to the story of the rise in cost of college. It's part of the bigger and broader story, because what happens too is that the federal government begins to roll back its contributions to higher education.
Right.
And so that means there's a shift in that cost from the public sector, from the public sector to individuals, from institutions to individuals. And this is what explains the part of the rise in cost of college. And so it's part of this bigger and part of this bigger story about the public sector and government's rollback of its contribution and support for higher education.
All right, and lastly, I mean, you also have a chapter on wage stagnation and the implications. I mean, again, it's almost, there's always like sort of a push and a pull, right? Like this dynamic where the federal government rolls back funding for publicly subsidized colleges, states cut back on this. Therefore, loans come in to fill that delta, because students now are required. They have more responsibility to pay those fees, and then that gives the opportunity. I mean, the fees to actually go to college tuition, and then the private industry comes in as like barnacles on this transaction, as a way of like stripping more cash out of that system. And on some level, that's what we see too with the idea of like payday lending, is that on one hand you pressure. There are forces that create wage stagnation, and then the other hand, you come in with a sort of a neoliberal solution, as some would characterize it, which is like, oh, we're going to loan you money so that you don't actually need to get paid, but we're also going to make a lot of money off that transaction. It's going to throw you deeper into debt, and so you'll be a repeat customer until one day when you can't.
Oh, no, you've summarized it very well. So there's very, very little I can really add to that. You're absolutely right. The rise of payday lending is really the private sector's most common, ubiquitous response to the generational crisis of wage stagnation. And I say most common response because there are more payday lenders out there than McDonald's and Starbucks, and studies show McDonald's and Starbucks combined. And so they're common, they're almost everywhere. And payday loans, unlike a credit card, payday loans is expressly designed to address the issue of lack of money from income. And so that's why it's called a payday loan. It's the loan. For that loan, you have to have two things which we consider sort of really pillars for middle class. You must have a paycheck, a working job, and secondly, you must have a bank account. You write a check, drawn from your bank and say that this check is going to be good in 2 weeks from now when I get my paycheck. And so these are the markers of middle class status. And so, but we see that these things, payday lending again has spread more wide and again more commonplace than both Starbucks and McDonald's. And these things we consider markers of middle class life. And I'll say this too, that the Federal Reserve earlier this year came out with a report that 4 out of 10 Americans cannot cover a $400 emergency expense. And so while we think of payday loans as something that other people might take out, realize that nearly half of Americans now are really living from paycheck to paycheck, and lack $400 to cover an emergency expense. So many of us are just one job loss, income shock away from a payday loan, and so it's something that really does open itself up to more consumers than those who are actually taking out the loan itself.
Devin Fergus, the book is Land of the Fee, and it is about the hidden costs and the decline of the American middle class. Thanks so much for your time today. I really appreciate it.
Thank you, Sam, and go Dodgers.
We'll see. All right, we'll see. Right. I wouldn't bet on it, but I appreciate the time. Thank you.
All right, thank you.
Bye-bye.
Take care.